If you are preparing for an investment banking interview, focus on financial knowledge, valuation methods, market trends, technical skills, communication, and confidence during interviews. Research the company thoroughly, practice behavioral questions, demonstrate analytical thinking, and prepare clear examples showcasing achievements, leadership, teamwork, and problem-solving abilities. For deeper insights, listen to our podcast covering investment banking interview questions with sample answers. Also, check out our job guide featuring 40 popular interview questions and answers.
So picture this, right? You walk into a job interview. You've got, like, the perfect tailored suit, your resume is totally pristine, and you are fully prepared to talk about your 5-year plan.
Right, the standard corporate routine.
Exactly.
Yeah.
But instead of asking about, your greatest weakness, the hiring manager just stares at you across this huge mahogany table. And they say, I have a company trading at a 20 PE ratio and one at an 18 PE ratio. They are identical. Which one do you buy and why?
Oh, wow. Yeah, welcome to Wall Street.
Right. You aren't just in an interview anymore. You are in this intense psychological and technical gauntlet.
It really is the absolute definition of a trial by fire. I mean, investment banks are notorious for their 80-hour work weeks and just extreme pressure.
Yeah, absolutely.
The people across the table, they already know you have a solid GPA. What they're doing in that room is stress testing your mental architecture in real time. They want to see if your analytical framework shatters the second you step off the syllabus.
And whether you are prepping for one of these high-stakes interviews yourself, or you're just insanely curious about how the financial elite gatekeep their most lucrative jobs, this deep dive is exactly what you need.
There is a very specific playbook they use to vet people.
There is. And our mission today is to decipher that playbook. We are analyzing this really comprehensive guide from Forage. It outlines 25 actual investment banking interview questions and the exact answers they demand.
It's a fascinating look at a process that requires a wild mix of technical fluency, logical agility, and just extreme grit.
Okay, let's unpack this. Because before an interviewer even lets you touch a calculator, they have to figure out who you are, right?
Right, exactly. The technicals mean nothing if you're going to burn out in 3 months. So the opening phase of this gauntlet is basically a vibe check. It's about proving you actually have the stamina for the grind.
So they start with something deceptively simple, like, why investment banking? Which honestly feels like a trap.
Oh, it is 100% a trap.
Because if you walk in and give some generic answer like, oh, I enjoy fast-paced environments, or I'm looking for a challenge, you are dead in the water.
Yeah, those aren't reasons to sleep under your desk on a Thursday night.
Exactly. You need a deeply personal tie to the mechanics of finance to survive that.
Right. Those boilerplate answers are a massive red flag because they just show a lack of industry awareness. You have to articulate a compelling narrative. The bank wants to know that you already consume financial news recreationally. Which
brings up the pivot they use to test that authenticity, right? They'll ask you to pitch a company you admire or dissect a recent deal.
It's the ultimate put your money where your mouth is moment. If you claim to love finance, you should be able to casually talk about a recent merger or a stock you actually hold.
And the guide points out that you can easily tie this to a personal interest to make it memorable. Like, say you are a massive gamer. You could walk them through the market mechanics of a mid-sized video game developer that recently went public.
That is such a great strategy.
Yeah, because it proves you are constantly analyzing the world around you through a financial lens, not just memorizing stuff.
And it connects your authentic life to market movements. That makes you vastly more memorable than the candidate who just parrots back a headline they skimmed in the Wall Street Journal that morning.
So true.
Yeah.
But then right after that, you face the behavioral gauntlet. The interviewer will throw out these scenarios asking about, like, a time you disagreed with a manager or failed at a really complex task.
And the industry standard response here relies heavily on the STAR method. Situation, task, action, and result.
But the STAR method isn't just a mnemonic to remember your story, is it? It's really a test of conciseness.
Precisely the point. They are evaluating how you communicate under pressure.
Right, like can you distill a chaotic interpersonal conflict into a structured, logical sequence without rambling for 10 minutes?
Because when you are briefing a managing director who has exactly 3 minutes between flights, they only want the situation, the action, and the result. They do not have time for fluff.
Wait, let me push back on one of the behavioral questions from the guide, though. Because the interviewer sometimes asks, what are your hobbies? Do they actually care? Like, does a managing director at Goldman Sachs care if I knit on the weekends?
Well, no, they don't care about the knitting itself. What they care about is what the hobby signals about your obsessiveness or your ability to handle multiple high-stress commitments.
Oh, interesting.
Yeah, having work-appropriate hobbies shows you aren't just a robot. But the real points are scored when a hobby demonstrates relentless drive.
So, like, if your hobby is analyzing microcap stocks late at night.
Exactly. Or running a profitable e-commerce side hustle while carrying a full course load, that signals the exact type of obsessive energy they're trying to hire.
That makes a lot of sense. And similarly, when they ask what kind of work environment you thrive in, you are effectively being tested on your willingness to suffer.
Pretty much, yeah.
Right, because if you tell an investment bank you do your best work in a slow-moving, low-intensity, highly collaborative environment, they will literally show you the door.
They will politely thank you for your time, and you'll never hear from them again. You have to signal that you are energized by intensity, high stakes, and really demanding management.
Okay, so once you've survived that cultural vibe check, once they basically believe you have the grit, the immediate next hurdle is proving you have the financial literacy to actually do the work.
Yes, the polite conversation ends here, and the technical gauntlet drops.
This is where they test if you understand the actual machinery of a business. Now, anyone listening to this deep dive already knows the holy trinity of financial statements, right? The balance sheet, the income statement, and the cash flow statement.
It's the absolute baseline.
Yeah, an interviewer isn't going to ask you to define what revenue is. They want to see if you understand the plumbing connecting all three of those statements.
The classic trap here is the integration question. They will ask you something really specific, like, walk me through how a $10 increase in depreciation affects all three financial statements.
And if you just memorize definitions, your brain completely freezes.
Exactly. But if you actually understand the plumbing, depreciation lowers net income on the income statement.
Right, which then flows to the top of the cash flow statement.
Yeah, where the non-cash depreciation is added back, which ultimately changes your ending cash balance. And then that flows to the asset side of the balance sheet to make everything balance perfectly.
Okay, so what does this all mean? It basically means taking those interconnected statements and answering the ultimate question, how do you figure out what this company is worth?
Valuation, the core of the job.
Right. And I like to think about valuing a business the same way you value a piece of real estate. Like if I want to know what a house is worth, I can look at what similar houses in the neighborhood are trading for right now.
A very solid starting point.
Or I can look at public records to see what similar houses actually sold for last year. Or, third option, if I'm buying it as a rental property, I can ignore the neighbors entirely and just mathematically project how much rental income it will generate for me over the next 10 years.
I love that. That framework perfectly mirrors the three core valuation methodologies in finance.
Okay, walk us through how those connect.
So, looking at similar houses currently on the market is your comparable company analysis. You look at peer companies, assessing their stock price, their price-to-earnings ratio, and their EBITDA.
And EBITDA is earnings before interest, taxes, depreciation, and amortization.
Right. Which gives you a really raw look at operational profitability before taxes, and weird accounting quirks muddy the waters.
Makes sense. And my second point, looking at historical sales.
That is precedent transaction analysis. You are analyzing the actual premiums paid in recent mergers and acquisitions of similar companies.
And the rental income analogy is obviously the discounted cash flow analysis, the DCF, where you project future cash generation.
Exactly. But before an interviewer asks you to build a DCF, they're going to test your understanding of value itself. Specifically, they'll ask you to explain the difference between enterprise value and equity value.
Which seems like a subtle difference, but it's huge, right?
It is a critical distinction that trips up a surprising number of candidates. Enterprise value is the total overarching price tag of the entire business.
Like what it would cost to acquire the whole operation outright.
Yes. Whereas equity value is simply the value of the shareholder's slice of the pie. It's basically the market capitalization.
The conceptual formula for enterprise value makes total sense once you think about it like an acquisition. You take the market cap, which is the cost of all the shares, and you add the total debt, but then you subtract the cash.
Right.
Adding debt makes sense because if I buy your company, I have to assume all your outstanding loans. I have to pay off your mortgage, so to speak. But why are we subtracting cash? That always sounds weird to people.
Well, think about it from the buyer's perspective. If you acquire a company for $100 million, but that company has $20 million just sitting in its bank accounts, You get to keep that cash the second the ink dries.
Oh, right. So it effectively subsidized your purchase.
Exactly.
Yeah.
Your true cost, your actual enterprise value, was only $80 million.
Okay, so a candidate has walked through the multiples, they've explained enterprise value, they've navigated the comps. Now the interviewer is really going to make them sweat.
This is where it gets intense.
Yeah, they are going to demand that you verbally construct the hardest valuation method on the spot. We're getting deep in the weeds with the DCF analysis.
The DCF is the ultimate separator in these interviews. The premise is straightforward. A company's only worth the present value of its future cash flows.
But the execution is incredibly complex.
Very. You start by projecting the unlevered future cash flows over like a 5 to 20 year period.
Unlevered meaning you are looking at the pure cash generated by the core operations, completely ignoring the company's debt obligations or interest payments. Right.
Exactly. You ignore the debt, but you can't project cash flows out to infinity.
Right. At a certain point, usually around year 5 or 10, your crystal ball gets too foggy. Nobody knows what's happening in 20 years.
So that's where you have to calculate a terminal value. It's a lump sum representing what the company's worth from that year onward.
And the guide mentions you have to justify how you calculate that terminal value.
Yes, there are generally two ways. Are you using the growth in perpetuity approach, where you assume the company will just continue churning out cash at a stable macroeconomic growth rate forever?
Or the other one, the exit multiple approach.
Right, which assumes you are going to package this company up and sell it to someone else, like a private equity firm, at the end of year 5 based on a multiple of its EBITDA.
But here's the trick, though. You've projected out millions of dollars in the future. But a dollar tomorrow is inherently worth less than a dollar today because of inflation and opportunity cost.
Time value of money, yep.
So you have to discount all of that future money back to today's present value to find your enterprise value. And the rate you use to discount that money in an unlevered DCF is the WACC.
The weighted average cost of capital. The WACC is an absolute beast of a concept.
I mean, even the formula looks terrifying. It's the percentage of equity times the cost of equity plus the percentage of debt times the cost of debt, multiplied by 1 minus the corporate tax rate.
Right. It represents the required rate of return for everyone who has given the company money. It's the blended average of what your equity investors demand and what your lenders demand, weighted by how much of the company is funded by stock versus debt.
Okay, here's where it gets really interesting, though. Because in this capital structure tug of war, the guide states that the cost of equity is fundamentally more expensive than the cost of debt.
Yes, it is.
Let me push back on this, because to a layman, that sounds totally backward. Isn't debt a bad thing? Like, why is borrowing hundreds of millions of dollars from a bank cheaper for a company than just letting people buy shares?
What's fascinating here is how the legal structure of risk actually dictates the math. When you buy equity, you are an owner, yes, but you are at the absolute bottom of the capital structure.
Meaning you get paid last.
Exactly. You aren't guaranteed a single dividend. If the company goes bankrupt, the lenders and bondholders get to take the liquidation assets first. Because the shareholder assumes a massive amount of risk, they demand a massive potential rate of return.
And that high expected return makes equity incredibly expensive for the company to issue.
Exactly. And the lenders, they have a legally binding contract guaranteeing them fixed interest payments, and they are first in line during bankruptcy. Lower risk means they accept a lower rate of return.
Right. But there's another piece to this, right? The taxes.
The true superpower of debt is the tax shield. The interest payments a company makes on its debt are tax deductible.
Oh, wow.
Yeah. Every dollar spent servicing debt actively lowers the company's corporate tax bill.
So if a company have highly predictable, stable cash flows, it is actually financially irresponsible not to take on debt, because the debt gives them tax shields, mathematically lowers their overall WACC, and increases the returns for the existing shareholders through leverage.
It is a delicate balancing act, though. Too much debt and you risk bankruptcy during a downturn. But the optimized use of debt makes the entire enterprise vastly more valuable.
Which brings us to the most nuanced variable in this whole DCF math soup, beta. The interviewer will ask, what is beta and why would you unlever it?
A classic question.
Now, we know beta measures volatility against the overall market, like the S&P 500. If the market has a baseline beta of 1.0 and a tech stock has a beta of 1.5, It means that tech stock is going to swing much higher during a boom and crash much harder during recession.
Right, it holds more inherent risk. But the complexity arises when you are an investment banker trying to value a private company.
Because you cannot simply look up the beta of a private company on a stock exchange. Its shares aren't publicly traded.
Exactly. So you have to borrow the beta from a similar public company.
But you can't just copy-paste it, right? Because that public company has its own specific amount of debt, and debt artificially amplifies volatility.
Yes. So you have to mathematically unlever the public company's beta to strip out the effect of its debt.
It's like checking the raw horsepower of the engine before you factor in how heavy the specific car is.
The horsepower analogy is excellent. Once you have that pure, unlevered industry volatility, you can relever it using the specific debt profile of the private company you are actually trying to value.
You are isolating the fundamental business risk from the financial risk created by management's debt choices.
Exactly. And showing an interviewer you can seamlessly navigate from beta to WACC to terminal value proves you possess the mechanical fluency required on the desk.
But knowing what a company is worth is only half the battle. The interviewer now shifts to the strategic application of all this math. We are moving into the art of the deal, basically. Mergers, acquisitions, and IPOs.
They want to know what you would actually do with this asset.
Right. And a standard prompt is asking for the core drivers behind M&A activity. Now, an unprepared candidate will just list generic reasons like growth or synergy.
Which means nothing. A strong candidate explains the underlying mechanisms.
Yeah, they explain how buying a supplier gives a company actual pricing power. Like, if you acquire the company that manufactures the microchips you use, you suddenly control the cost of your own raw materials.
And more importantly, you can potentially squeeze your competitors who rely on that exact same supplier.
Exactly. Or a company might acquire a scrappy tech startup simply to absorb a proprietary patent, saving them 5 years of internal R&D.
And if you are representing the buyer operating on the buy side, you must navigate a highly structured dance. You start by aggressively filtering targets based on strategic fit. Then you conduct quiet, back-channel checks to gauge if the target's board is even receptive to a buyout.
And during those intense negotiations, you are constantly monitoring the target's net working capital, or NWC.
Yes, very important.
Because this isn't just an accounting term, it's a vital health check. Net working capital is your current assets, like your inventory and cash, minus your current liabilities, like short-term debts and accounts payable.
It dictates day one survival. If the NWC is deeply negative, it means the target company cannot cover its immediate bills.
Wow. So as the buyer, it means the purchase price is kind of an illusion.
Completely, because the second you take over, you are going to have to inject millions of dollars of fresh cash just to keep the lights on. It fundamentally alters your leverage in the negotiation.
The same level of mechanical scrutiny applies to an initial public offering, too. An IPO is basically that monumental transition of a private company selling shares to the public for the first time to raise capital.
Right, and the investment bank is the architect of this entire event. They build the financial models, write the prospectus, and aggressively market the shares to institutional investors, all while allowing early founders to finally cash out.
It's a massive undertaking.
Yeah.
But here is where the interview takes a hard left turn into the surreal.
Oh, the curveballs.
Yeah, because honestly, all the formulas for unlevering beta, calculating WACC, and analyzing net working capital, they can be rote memorized.
They can. An interviewer knows that a candidate can lock themselves in a library for a month and parrot back the mechanics of a DCF.
Right. So to truly test a candidate's mental architecture, Wall Street throws theoretical curveballs that aren't in any finance textbook.
The cognitive stress tests. These brain teasers are designed to rip you out of your rehearsed comfort zone and force you to process unexpected logic on the spot.
Let's go back to that scenario I posed at the very beginning of the deep dive. Two companies are almost exactly the same in every way, except Company A is trading at a 20 PE ratio and Company B is trading at an 18 PE ratio. Which do you invest in?
Well, the PE ratio tells you how much you were paying for one single dollar of a company's earnings.
Right.
So in a vacuum where all other variables are perfectly identical, the irrefutable answer is Company B. A lower multiple means you are paying $18 for every dollar of profit instead of 20. It is the fundamentally better value investment.
If we connect this to the bigger picture, answering that proves you understand the core philosophy of value investing, not just how to execute an Excel function.
Exactly. But then they abandon finance entirely. They hit you with the genuinely bizarre question.
Oh yeah, the guide lists things like, Why are manhole covers round? Or how would you figure out how much an aircraft carrier weighs without using a scale?
These questions induce absolute panic because the candidate frantically searches for the correct answer. But the secret of the gauntlet is that the actual answer is entirely irrelevant.
Wait, really? They don't care about the answer.
Not at all. They are testing your analytical framework. When a completely unprecedented market crisis hits and there is no historical data to guide you, do you freeze or do you logically deconstruct the problem?
It reminds me of being in like a middle school math class. The teacher didn't care if you wrote the correct final number at the bottom of the page. They demanded that you show your work. The investment bank wants to see the gears turning in your head.
Exactly. For the manhole cover, a round cover can never fall down into a round hole, regardless of the angle. A square cover turned diagonally would slip right through. Plus, they can be easily rolled by a single worker. It's just a test of practical logic.
And the aircraft carrier problem.
That tests your ability to segment massive, overwhelming data. A strong candidate would verbally break the ship down. They might say they'd calculate the cubic volume of the steel hull, multiply it by the density of military-grade steel, then add the standardized weight of the onboard jets, the crew, and the fuel.
Oh, that's smart. It shows you can take an impossibly large valuation and break it into actionable, calculable pieces.
Precisely.
So, stepping back and looking at this entire journey, a successful investment banking interview is truly a staggering achievement. You have to prove you possess the obsessive dedication required to survive the grueling hours.
Without a doubt.
You need a flawless, granular grasp of technical mechanics. From understanding the tax shields in WACC to isolating fundamental risk with unlevered beta. And finally, you have to possess the cold, calculating logic to handle bizarre theoretical brain teasers without flinching.
This raises an important question for the broader corporate world, though.
What do you mean?
Well, we have just explored how incredibly intense this hyper-technical, multi-layered vetting process is for Wall Street. It was built to find a very specific type of elite, high-pressure problem solver. But as big data, complex analytics, and deep financial modeling become the central nervous system of almost every modern business, not just investment banks, how long until these aggressive logic and finance stress tests bleed out of Wall Street?
Oh, I see what you're saying.
Are we looking at a future where this rigorous analytical gauntlet becomes the standard for getting hired in tech, healthcare, or logistics? Are we all going to need to know our personal WACC just to sit at the table?
It is a wild, slightly terrifying thought. The parameters of the training camp might be expanding. We started this deep dive by comparing the Wall Street interview to an elite, cutthroat sports tryout. It turns out what they're really looking for isn't just someone who can discount future cash flows or optimize capital structure.
No, they're looking for someone who doesn't panic when the rules of the game suddenly change.
Exactly. Well, thank you for joining us on this deep dive. Keep questioning the numbers behind the world around you, and we'll see you next time.